In this video, I'm going to break down the 5 ETFs available to UK investors that, if you buy and hold, can build you a powerful wealth building portfolio and make you very rich in the long term. Now, some of these might not be the most popular ETFs that you hear about all the time, but depending on your risk tolerance, your long-term goals, and your investing horizon, they can be just as powerful, if not better. And if you stick with me to the very end, I've got a special bonus 6th ETF. It's a high stakes bet on one of the biggest economic transformations in modern history, so you won't want to miss it. Now, what I will not be doing in this video is listing off some, random funds. I'm going to be using the same professional framework that the pros use, the core and satellite strategy. We will look at 2 potential core holdings, the stable diversified bedrock of your portfolio, and 4 powerful satellite holdings that, are smaller targeted allocations and they are designed to enhance your returns. Every single fund I mention in this video has been selected based on, tough criteria, a strong historical track record, a low expense ratio, and clear, compelling reasons why it's aligned with your long-term growth. I'll also be scoring each ETF based on their potential to generate returns, their volatility, and just as importantly, the risks that you must absolutely be aware of before you invest a single penny. Now, what if you could invest in the 500 largest and the most influential companies in the United States with just a single click? You get a direct stake in businesses that are shaping the future of the global economy. Well, you can. This is the iShares Core S&P 500 UCITS ETF with the ticker CSP1. Now, this ETF job is very simple. It precisely tracks the performance of the S&P 500 index. It physically buys and holds shares in all 500 companies from giants like Nvidia and Microsoft and Tesla down the list. So, why is this a rich-making ETF? Well, first, it's incredibly cheap. The expense ratio is a tiny 0.07%. Now, over a multi-decade investing journey, that extra low fee means significantly more of your money stays in your pocket, and this helps to compound your money for you. Second, while it's a US fund, you are buying global titans, companies like Apple and Microsoft. They derive a huge portion of their profits from international markets, giving you powerful indirect global exposure. And the performance, speaks for itself. It's delivered a staggering 14.24% average annual return over the last 10 years. But you have to be aware of the risks. This ETF is 100% a bet on the continued performance of the US stock market. Any period of US economic stagnation could severely impact the portfolio. It's also heavily concentrated, in the tech sector, which makes up about a third of the entire fund. Now, so based on its unparalleled historic track record, the total return potential, I would say, is high. While it's concentrated in a single country, its holding of 500 of the world's largest company means that its volatility is medium. And because the main risk is concentration in one market, not a credit or operational risk, I would say its overall risk profile, I'll give it a medium. So you have a 100% bet on America. Is that a risk that you're personally willing to take for these returns? Let me know your thoughts down in the comments below. Because if that concentration makes you nervous, then our next fund is designed to be the complete opposite. Now, this brings us to our second core holding. This is the quintessential buy the world investment, and it's called the Vanguard FTSE All World UCITS ETF with the ticker VWRP. This ETF tracks the FTSE All World Index, giving you a piece of over 3,600 companies across approximately 50 countries, spanning, both the developed and the emerging markets. You are not betting on a single company or a single sector or a single country. You are participating in the long-term upward trend of global corporate profitability. The fund is self-rebalancing and it gives you built-in exposure to the faster-growing economies of the emerging world. Now, the biggest risk here is understanding what you actually own, because despite it being a global fund, the US market is so dominant that it makes up roughly 64% of the entire fund. This means its performance is still highly tied to the S&P 500. This fund is designed to be the market, not to beat it. So its total return potential is medium. While fully invested in equities, its vast diversification helps to smooth out bumps, giving it a medium volatility, and it represents the baseline for a global, equity investor. So I would say its overall risk profile is medium, making it a quintessential core holding. Think of it this way. Investing only in CSP1 is like betting on your favorite football team to win the league, while investing in VWRP is basically investing in the entire league to have a profitable season. Okay, so locking in your core is the single most important decision here. Get this part right, and you're already, I would say, 70 to 80% of the way to building a solid portfolio. Right, so we've built our foundation. Now it's time to add the satellites. These are smaller but targeted holdings that make up, say, the remaining 20 to 40% of your portfolio. They are designed to enhance your returns by giving you exposure to specific themes. They can be riskier, but they also offer the potential for outsized growth. Now, what if I told you that one of the most powerful ways that you can build wealth isn't about chasing explosive growth, but also finding boring, high quality companies that pay you more and more money every single year? One of them is the SPDR S&P Global Dividend Aristocrat UCITS ETF with a ticker GLDV. Now, for any company to get into this exclusive club, they must have a policy of increasing or maintaining their dividends for at least 10 consecutive years. The fund's holdings are mature and stable companies from defensive sectors like utilities and financials. Over the last 5 years, it has returned an annualized 10.35%. The expense ratio is 0.45%, and critically, this ETF is a distributing fund, paying out a substantial dividend yield of around 4%. This means that every quarter, it pays that cash dividend directly to you. The reason that this can be, a wealth builder is the snowball effect of when you reinvest those growing dividends over decades. But you need to be aware that this fund is almost guaranteed to underperform, compared to the more tech-heavy funds during strong tech-led bull markets. Now, the total return is a blend of capital appreciation and a strong income stream. So I would give it, the total return potential a medium. The defensive nature of its holdings typically leads to lower volatility than the broader market. So I'll give it a volatility score of a low to a medium. It also represents a more conservative approach to equities, making its overall risk profile a medium. Now, that was our defense. Now let's play some offense. Now this one is the high-tech tech titan, the iShares Nasdaq 100 UCITS ETF with a ticker CNX1. It tracks the 100 largest non-financial companies on the Nasdaq, giving it a very laser focus on innovation. Now, over the last 10 years, it has delivered an incredible 19.12 annualized returns. Its expense ratio is 0.3%, and it's an accumulating ETF, meaning that the dividends are automatically reinvested for you, which is highly efficient for compounding. But this power does come with extreme risks. The top 10 holdings make up over 50% of the fund. And that negative 28.5% drop in 2022, that's not just a number on the page. It's a brutal reminder that this kind of high octane growth is never a straight line. The fund is positioned to basically capture massive upside if tech continues to dominate. So I will give its total return potential high. This comes as a direct consequence of, its extreme concentration in one single sector, giving it also a high volatility. It is an aggressive satellite holding, meaning its overall risk profile is also high. Okay, we've added our US tech powerhouse, but what about the next generation of growth? Now, for that, we need to look beyond the developed world. To capture this powerful trend, we can use the iShares Core MSCI EM IMI UCITS ETF with a ticker EMIM. This fund provides an incredibly broad exposure to over 20 emerging countries, including China, Taiwan, and India. Its expense ratio is a remarkably low 0.18%, and it's also an accumulating fund. Now, over the last 10 years, it has returned an annualized 7.1%. The long-term case for growth here is powerful. You get access to superior economic growth and portfolio diversification. However, the risks are immense, with geopolitical instability being the most significant factor. Its potential is also directly linked to, the higher economic growth rates in emerging nations, giving it a high total return potential. Now, this potential reflects the combined impact of the equity risks, geopolitical uncertainty, and also currency fluctuations, resulting in what I would say is a high volatility. This is a strategic satellite holding, so its overall risk profile, I would give a high. Now, everything we've talked about so far is an investment in companies and economies that exist today. But this final bonus fund that I'm about to talk about, this is a pure bet on the future. And its performance history is one of the wildest, most contradictory stories I have ever seen in an ETF. Now, I need to be crystal clear from the start. This is a speculative satellite holding. It should only ever represent a very small portion of any investor's portfolio. This ETF is a thematic bet on the global energy transition, the iShares Global Clean Energy UCITS ETF with the ticker INRG. It invests in companies that are, involved in the clean energy sector, from solar panel manufacturers to wind turbine makers. Now, we need to talk about its wild performance. The 10-year annualized return is 5.78%, but the 3-year return is negative 12.56%. How is that possible? Well, in 2020, you see, the fund surged over 88% and has since given back a huge portion of those gains, highlighting its boom and bust nature so far. The expense ratio, is our highest today at about 0.65%. It's also a distributing ETF. So why am I talking about it? Because this investment thesis is forward-looking. It's a bet on trillions of dollars flowing into this sector, supported by massive government policies, with the whole net zero thing. But the risk is extreme volatility and policy dependence. And so the potential here is an immense one if the energy transition materializes. So I'll give this a high, total return potential, as it's a thematic sector-specific fund that is subject to both policy risks and speculation. I'll give it a very high, volatility. Now, this is a speculative satellite holding, so I'll give it a very, very high overall risk profile. And so, guys, if you got any value from this ETF breakdown, please give the video a like. And if you want to see more videos like this, please do subscribe. Now, thanks for watching. Continue to crush it, and I'll see you in the next portfolio video. Bye.